Good afternoon, everyone. Today's date is 2/14 of 2013, and happy Valentine's Day to all of our traders, all their families, and anyone viewing this live video on the S&P. And hopefully you have a good time with your family on Valentine's Day. This is the S&P 500. This is the way that we started with the gap, just like we did in calendar 2012. And we took out these highs finally, and we've gotten right up here. This is a daily chart. This is where we were consolidating, and we've gradually ramped right up here to 1521 area that we had talked about several weeks ago. And the intraday price volatility is 9.12 from the bottom up, and there's the rising 10-day moving average in 20. What I would like to tell people is watch the trend line. Now, let's take that same trend line and let's get right back over here where we were during the financial crisis's breakdown. Here's that 1521 area. So far, we are right up here where some of these major reversals back in the financial crises, one of them was right here. That was on 11/1 of 2007. But then we started another one right here, and that was on 2/10 of 2007. This upper trend line is where we're at right now. 1524 is why I drew this right here, because we closed at 1521.38. And mathematically in our other system, this is just a standard chart to show you. We're right up here. Now let me tell everybody something. This is a new bull trend now. The bear trend that started out years ago in year 2000, this is the 13th year that we've been in a long-term bear. And when we were at the highs back in year 2000, it takes anywhere from 12 to 14 years to work that whole time period in the markets off. And basically, it is set up mathematically to say that this would be the infancy stages of a new bull. And I said in the infancy stages. That means that bulls are created in various different bull markets over the years, but it is the beginning of a new bull in the infancy stage. It's barely in that stage, and new bulls have to grow. But bulls are going to have pullbacks. We've gone parabolically up on the daily of this calendar year of the first 45 days. Tomorrow will be 45 days, let's say, or close to it. But nonetheless, we're getting a little bit top heavy here, and we've gone a long ways, and a market needs pullbacks. Every bull rally has to have a pullback to bring money off of the sideline. And you'll have to have your shopping list together. And seasonality wise, there are various different months where you do get pullbacks. Every bull or new bull run will have to have its pullbacks like they all do. And the thing about it is, that's when you would want to be buying the dips. Yes, it is technically and mathematically the 13th year right here from the original bear of 2000 mathematically is broken right now. And we're right back up to these highs over here back in 2007. And we're right here at 1521.38. I'll just let everybody know that the tape is trying to read higher. So we all know one thing for sure. There's a neckline at 1548 right there. There's other little areas in here, like 1531 or so right there. We'll look in our other system. I just want people to see where we are at as far as how far we have traveled to 1521 right here, back in this time frame. So that we look to see where the market will hit that wall of resistance as far as the S&P 500 bull, it's a new bull that has to have a pullback, and you will want to buy good quality companies, and money on the sideline is ramped up to want to get into equities. And therefore, when things change, everybody should get back into equities. You shouldn't be robbed of what happened over the last 12, 13 years in the marketplace. If you were one of the ones that were washed out, hey, it's time for you to think about how this new bull is coming back. And yes, we got lots of services at stockmarketfunding.com.